for Tuesday, the 27th of August, 2019. Well, Monday saw quite a pullback from Friday's sharp sell-off in equities as President Trump suggested the Chinese were willing to get back to the negotiating table for a trade deal. Despite the Chinese denying they never actually said that, markets were still wanting to grab onto some hopes of optimism as both equities and the US dollar generally benefited. Tuesday would start off fairly quiet. Asian shares took their cue from Wall Street, generally rallying across the board with the exception of Hang Seng that closed fairly flat on the day. European shares would also edge higher, and on the FX front, dollar yen would actually dip a bit lower down to 105.60 and Aussie down to 67.47. So kind of interesting there. You're going to move lower in Aussie yen, which would be a risk-off move, but yet the respective equity markets were all happy to move higher, following on from Wall Street. So a little bit of divergence there, if you like. Sterling will go the other way from Aussie. It would go higher en route to a high of 122.88 during the European session amidst renewed Brexit optimism. Still hope that something positive might come out of Prime Minister Boris Johnson's various discussions. And crypto started the day hitting slowly lower. Bitcoin clinging on to the 10,000 level, while Ethereum dipped down to 185. So the US day would start actually with a marginally higher open for equities. No further headlines about trade or ongoing protests in Hong Kong have given the markets an air of calm to start the day. But as per usual, that would not last for too long. The Dow Jones, having actually been up over 100 points at one stage, is down over 130 points by the midpoint of the US session. US yields are getting hit hard, with the 10-year yield down to 1.49% and the yield curve once again becoming inverted. Euro dollar drops to 110.86, while gold rallies up to 15.44. Sterling extends its rally up to a high of 123.08 on the back of some comments from the Irish Foreign Minister that alternatives to the Brexit backstop are being discussed. I guess the UK could leave with a deal yet, but I'm sure we're going to have many more ups and downs before we get to the deadline date of October the 31st, which of course is probably somewhat appropriately Halloween. As the US day comes to an end, all eyes remained on the US bond markets as interest rates continue to slip lower, but a US close, the 10-year yield has slipped to 1.47%. Equities close just marginally off the lows, with the Dow Jones down 120 points. We have euro sitting at 110.90 and dollar yen at 105.75. The daily roller coaster continues. It's hard to call them directionless markets, but when we're just going up and down and sideways, that's essentially what they are. So moving on quickly to a technical piece. I've actually returned to the Australian dollar here, which is something I highlighted last week. With almost all markets, maybe with the bond markets aside, really chopping around. I want to say chopping around, I really do mean sort of, like one day down the next type thing. The technical picture can become pretty clouded. So in that situation, it's best to focus on some of the bigger picture levels than get caught up on some of the short-term levels, which tend to get broken very easily when we are seeing the sort of volatility we're seeing at the moment. So, we've had a couple of volatile days here for the Aussie, but as you can see, the setup I described last week, we had this wedge pattern forming, which obviously is now formed. And, as I suggested at the time, often when you get a wedge pattern, you expect to see a fairly sharp break out of it one way or the other. On this occasion, we had a very sharp break down, or a fairly conservative break, and then a really sharp break down, which was on Sunday night in the US, Monday morning in Asia, when we touched down to a low of 66.89. Since then, yesterday with the euphoria, if you want to call it that, of President Trump's announcement of that the Chinese were wanting to sit back down and talk about trade, we saw Aussie had that really nasty squeeze up to around about 67.90, which again took us up to this line. But today we've come back off as equity markets have given up the ghost a little bit, and the bond markets have once again seen the yield curve become inverted, which is generally a negative. So seeing as it come lower. Point being here, it's this is kind of a bigger picture type formation. It does go back a couple of weeks, and then beyond that, lurking. I'm just going for those of you who have the luxury of watching this, we can see here there's a very good line of resistance now at 68.32. It was originally acting as good support, and we had several attempts to break below it, failed, and then finally when it broke through quite convincingly and is yet to return above it. So, looking at the slightly bigger picture, longer term levels is certainly beneficial. And in the Aussie here, depending on just how conservative you are with your risk management, you probably would have survived even with some of the sharper moves that we've seen. Always good to keep that in mind, but the bigger picture levels are more important, I think, when we have volatile markets. Anyway, that's enough for me for today. I hope you've all had a good day trading. Hope you survived, and we move on to tomorrow, Wednesday. So I look forward to speaking to you then. Cheers.